Massmart's full-year profit declined 25%, hit by costs related to the $2.4 billion deal with Wal-Mart, as well as price markdowns it implemented in an attempt to gain a bigger slice of the domestic retail market. Joining us in studio now is the company's CEO, Grant Pattison. Thanks so much, Grant, for joining us today. Well, Massmart causing quite a shake-up in the retail space. Government is, of course, reviewing the deal that you've got with Massmart, while we've got unions appealing along with government. What are your views on this particularly, and particularly around risks that centre around the rejigging of this deal?
Well, you know, the rules and laws in South Africa are quite clear and quite simple. There's not a requirement for Massmart to negotiate with government. The requirement is that Massmart structure its deals in terms of the laws of the country and then submit itself to the regulator. We've done all that. The regulators approved it. It's within the union's right to appeal. It's not within the government's right to appeal. They can only take it under review. But it's actually the Competition Appeal Court that will review the deal and not government. And we will submit ourselves to their decision making.
Of course, you've got a creation of a 100 million rand fund to help develop suppliers. And, you know, one of that consideration that's possibly on the table is, you know, where that fund is not being seen as big enough right now, we're possibly going to look at that increasing moving forward. How does that affect your cost base, where we've already seen costs a big burden for the company?
Again, the Competition Commission has ruled that it's 100 million rand, so it's 100 million rand up until the time a court says otherwise. So we expect it to remain at that level. We're already planning to spend that 100 million rand. We've appointed an executive, Tunzi, to do that job. We're very excited about what we can do with South African manufacturers.
Okay, so confidence levels high there. Walmart deal only having benefits by 2013, but there must be some upside already. What have been the benefits of this deal so far? Because surely some procurement benefits have to have rolled in already.
Correct. We're not saying that we don't get benefits in the first year. What we're saying is costs come with integration and benefits come a little bit later. And so for the purposes of trying to forecast our earnings, it would be best to assume it neutral for the year. I would hope it would be positive. The benefits that are coming through already are mostly in procurement of goods not for resale, so IT and supply chain, material, steel and stuff like that. We'll expect other benefits, which are mostly about technology transfer rather than procurement, to come through perhaps in the second 6 months.
So while we wait for those benefits to fully filter through, let's put it that way, pressure is coming through, and that as a result of the price markdowns that you've induced so far. I mean, you're fighting for that bigger slice of the retail market, but many out there want to know just how far you'll go and how fast you're expecting those margins to recover. Well,
it's not correct to say that we've dropped prices to fight for market share. If the results actually show that the gross margins of the business increased over the past year on the prior year. What's true is the transaction costs impacted earnings negatively, but if one excludes the transaction costs, actually earnings grew at 10% and sales grew at 11%. So we think that's quite a solid result. What we have said is, though, looking forward in our food retail divisions, we are prepared when we open a store to fight aggressively. Do I think that's going to flow through to overall margins? Yes, but I don't think it'll be noticeable.
At a glance, when you're looking at these numbers, like you say, solid set of results coming through if you strip out Walmart. But if we have to look for disappointment, Masscash, which controls Cambridge Foods, does stand out there. I mean, it's come under a bit of pressure. So let's go through some of the factors behind the underperformance there. And, you know, has that at all impacted your fast rollout of stores?
So Masscash is made of a wholesale business and a retail business. Now, the wholesale business has been traditionally sensitive to low food inflation. So the underperformance in that division is fundamentally around low food inflation. We would expect that now to turn around as food inflation is now around about 5%. In terms of our retail business, we're trading very well and performing very well. What we have signaled the market is we are growing fast. We're going to become a 100-store, 10 billion rand business in the next few years. So we're investing in costs ahead of the curve there. I think everyone understands that. It's not a matter of let's run the business at a loss or drop the margins. We're just investing costs ahead of the curve there.
Well, Massmart's made 2 small acquisitions. Fruit Spot is an acquisition that's really caught attention. Safe enough to signal that you're going to be moving into this food space pretty aggressively?
Yes, correct. We've actually, over the years, made a few acquisitions. We have 2 fruit and veg businesses. We have 1 butchery business. Now, this is about getting access to supply. Massmart has not traditionally been in these categories, and of course, all the supply is already accounted for. So one of the ways of getting in here is to acquire these rather small businesses and then be able to pass on that procurement ability of those businesses, the benefits of that to our customers.
Now that you're in that space a little bit more so than you've been in the past, I mean, have you at all altered your assessment on the competition in that market and the kind of competition within the food retail space and perhaps more so in the lower end of the market than anything else?
We've always looked at that market as being very well serviced at the upper end. So they're very strong competitors, they have great offerings, we have world-class food retailers in South Africa. And so our entry into that part of the market will be smallish through Game Food Co and through Macro. Our more aggressive entry is at the lower end where we think it's underserved. And there we will press hard on with our Cambridge format, which is targeted at the commuting consumer.
Talking about developing the business further, RCS, so you're using that to provide credit to builders, but you've said that you want to develop this area of the business further as well. What exactly could we be anticipating in that arena moving forward?
Yes, we're probably underinvested in payment options for customers. So we, a couple of years ago, converted our game internal debtors business and gave it across to RCS. We've done a fantastic job in game with the game credit card. Now we have given RCS the opportunity to do the same thing in Builders Warehouse. We are going to explore further around trade debtors, international transfers, financial services in store. It's a huge opportunity that perhaps we underinvested in.
Well, is there any opportunity that you would run into running those credit facilities on your own?
No, I don't. I think we've decided we're not good at that. We will look to work with financial services companies as partners.
Well, let's leave it there. Grant, thanks so much for your time this afternoon. Of course, Grant Pattison, CEO of Massmart.